Hi everybody, this is Also Hub. I'm Giacomo, and today I'm again with Marco Santanché from Unbiased Alpha. And today we're going to talk about trading strategies. This is the second episode. If you haven't watched the first episode, I will link it in the video so you can keep up with all the things Marco is sharing with us. So Marco, without any further, let's get into the content of today. And yeah, let's go.
Thank you, Giacomo, and welcome back, everybody, or welcome if this is your first episode. We're going to discuss trading signals today, and from a very methodological perspective and but very practical perspective as well. And yes, so this is the second episode as mentioned because this is the first piece we are going to introduce for investment strategies. And we will introduce the further ones in the next episodes. So what are trading signals? Trade signals consume data to produce buy or sell indicators or values, if we want. There could be a number for each asset we have in scope. So for instance, for a stock or multiple stocks, and or they could just not be there if there's no signal in this case. And depending on the methodology, they could imply some calculations that one must do or some pre-processing on the data we get from the providers in order to ensure we can cover every aspect of the data side. So for instance, problems like outliers or extreme values, and or maybe missing data and data that we want to fill, forward fill, backward fill, and all the rest. The data we can use has no limitation. We could use whatever data we want. We can start from OHLC data, which is the candle data, but we can also use fundamental data, news, technical data, or technical analysis if it comes directly from the supplier, or if we instead calculate from the original raw data we get, and anything else we would like, even alternative data. And signals can tell us when to enter a trade, so we could run a signal iteratively to find that every new data point or every n new data points when we need to enter into a long or short trade, how confident we are in the trade. So it could be that the signal has a magnitude, and the magnitude tells us how important it is to go long compared to other times, maybe, as well as the direction of the trade. Of course, in some cases, we could have long-short signals. Some other cases might include only long signals or anything else, depending on the strategy and setup. And and then the exit time from a trade. So the signal could also just tell us to exit a trade without telling us buying or selling. And why are signals important? Who uses them, and what is needed to use them? How should we implement them, and where in the strategy? So at what time should signals be calculated before doing what and after doing what else? So who uses them? Active investment managers. Normally, passive investment managers don't really use investment signals because their target is just to replicate the index that they are following. Sometimes we could actually have a passive index that basically follows some updates from other resources. And so to some extent, we could say that's some sort of trading signal in the sense that we receive the update from the data flow, and we know that we have to adjust that following the index update. But normally, this is actually not considered a real trading signal. This is more for passive rebalancing strategies. In this case, we are instead following an active methodology. So when data comes, we calculate the signal and we want to use it to get some alpha or some outperformance compared either to the benchmark or in terms of absolute return. What is needed to calculate a signal? Normally, we need the data. Well, the data can be simple or can be more sophisticated and more, let's say, multidimensional, but we always need data, that's for sure, to calculate a trading signal. This data could also be just referring to the portfolio position sometimes. So it could be that our signal is calculated over our current portfolio weights, according to the methodology we would prefer. technologies. So of course the coding part or technological part, which could be even, you know, some cloud environment or some specific, let's say, technology indeed. So set up from an hardware or software perspective, such that we can actually calculate what we want to do. In some cases, this is very important, like in HFT or in deep learning applications or machine learning applications. And the methodology, of course, it must be consistent. It must handle all cases, and that's basically the formula that we implement in the technology consuming the data. Why are these signals used? Well, as we mentioned, it's from active investment managers. So the target is to find an edge in the market, and this edge could be your alpha. Not necessarily, however, not necessarily your signal is only providing you with the alpha component. It could also be just a risk management indicator that tells you when to exit, for instance. We could still consider this a trading signal because this signal is telling you when risk is too high and you need to exit, and this will eventually contribute to your alpha as well, even if it comes from another perspective. And where should I implement them? Normally, they are one of the first components in the strategy. Before that, we have to, of course, reprocess the data. So there should be a data component which can be done in many ways. It could even be internal to the signal. So the signal itself calculates something like moving averages or volatility, or maybe the fit of any model. And then afterwards, we calculate the trading signal and provide the signal to the strategy. And they should be at the core of active investment strategies, because without a signal, it's normally not possible to actually achieve outperforming strategies. However, we cannot exclude that we could use, for instance, only asset allocation strategies. So being always invested and never exiting or rebalancing according to any signal, just doing that according to the asset allocation model, which is a different thing. And how can we implement them? How can I implement a trading signal in my strategy? Normally, we need to use some methodology that makes some sense from as a strong rationale, let's say, from an hypothesis perspective. So it should be a research piece, either investment research, so something coming from fundamental analysis or macro analysis, and data science, because it could be that we want to implement some machine learning model or some techniques just to filter and arrange the data. And valuable data, because data should also speak by itself sometimes. We need to have some data that can tell us what we are trying to achieve. And a scalable approach, so something that is maybe overlooked a little bit, but it's very, very important. Something that can be used in different frameworks and different setups, different asset classes with different data columns, for instance, and so on. As an example, we could receive market data from our broker, and so only the candlestick data or even just the price if you want, and then purchase, for instance, in this case, we are using a technical analysis signal in this example that purchases a stock if its price is above the 5-day moving average. In this case, yeah, I'm considering simple moving average, but it doesn't really matter. It's just an example. The general idea is we get the price, we calculate the moving average, and then we translate this signal into a directional signal. Buy is equal to 1 or sell is equal to -1. Of course, another alternative could be to consider the magnitude. So if the distance is wider, the signal is maybe stronger. Or we could also do the opposite. So when the distance is closer, the signal is stronger, depending on what you are trying to achieve and why. It's always important to answer the why. So to not just use anything as a methodology and test, but think about why should it be more or less intense as signal, let's say. And what kind of signals do exist? What can we do? What are the possibilities? Well, data science and machine learning are definitely very hyped at the moment. So a lot of people discuss methodologies that use any model or deep learning model, very specific models, sometimes referring to the type of cells we use in the neural network or layers and all the rest. But it's not necessarily the case. It could even be just simple and still outperform or work. And my experience was normally that simple signals are very effective when used appropriately with risk management and asset allocation. Normally, we consider signals that allow us to develop strategies such as statistical arbitrage strategies, trend following strategies, factor investing style strategies, so something considering, for instance, a ranking system or a cross-sectional system that looks at multiple assets in a row, let's say, of our data and picks the most attractive ones according to some rationale. And then sentiment, news analysis, and anything else. So something that maybe is more relying a little bit more on the data, sorry, and less maybe on for instance the history of the strategy, because trend following, statistical arbitrage, and factor investing are very old, still important and working, of course, classes of strategies. And what can we achieve with signals? So signals cannot do everything, but they can do a lot of things. They can forecast, and this is normally a very common application of signals. So we can identify prices or trends of the securities. Well, for trends, we consider it a second category because it's not really forecasting. And indeed, it's more like classification systems that look at the current regime and act. And so, for instance, when the trend is positive, we purchase, or when the trend is negative, we sell, and anything we can do with trends. And they're not really aiming at forecasting the next data point, but rather the long-term behavior, let's say, of the strategy, or classifying the current trend of the strategy, which should be somehow robust. We can also work with arbitrage strategies. So a signal could tell us whenever an arbitrage opportunity arises in the market. For instance, we compare the price from two different brokers and purchase on the broker where we have a lower price, and sell where we have a higher price to basically execute an arbitrage strategy. This is also, of course, important for HFT, for instance. And in mispricing, which is slightly different from arbitrage, that's not necessarily the case I described. It could be just that, for instance, we look at statistical arbitrage strategies, such as the relative price of two securities, which are not necessarily with the same price, so two different stocks, but were maybe correlated or co-integrated. Normally, that's what we look at in statistical arbitrage. And we apply some strategy according to the mispricing of a single or multiple securities, like in pairs trading. But signals cannot necessarily achieve everything. For instance, asset allocation or risk management is not necessarily embedded in every signal we use. In particular, they cannot necessarily be adapted to all market conditions. So whenever we use a trend following strategy, we should also know that there are times where this strategy doesn't really work. And or we shouldn't maybe consider, maybe the strategy works, but with different parameters. So that's also something we need to keep into account, the fact that we should adapt maybe the model to different situations. Or they cannot be 100% accurate. For sure, out of sample, the performance of signals will be mixed, sometimes positive, sometimes negative. Maybe this would help us also in identifying times where the signal works and times where it doesn't. It's very important also to consider that actually they are not supposed to be 100% accurate, and accuracy is maybe sometimes overestimated in the sense that the direction is nice, but what really matters actually is size. So even if we have a low accuracy, but the returns we actually guess from our model are very high, then we might outperform still other strategies. This is both a good achievement, but also risky, because probably it means the model on average doesn't work, and it might be only by luck that we were able to outperform any benchmark. So we must be careful in this gray area where accuracy is bad, but we can still outperform the market. It could be on purpose, or it could be just accidental. And yeah, as mentioned, they cannot be all-round solutions, so they cannot really help us always in risk management, although sometimes they can, or execution, for instance. In execution, normally signals are not really that important, but it really depends on our application. And asset allocation, it's not necessarily true that a higher or larger signal in value it means a stronger signal for that asset. Maybe it's just due to, for instance, the magnitude of the underlying variable, such as the price level and or volatility and asset class and all other possibilities. So we must be careful. They can do many things, but it's not necessarily true that they can do all things, or they can be always trusted. Should we work with signals or not? Of course, signals have limitations and they have capabilities, let's say, or they help us in something and they can be dangerous when we trust them in full. So the short answer is yes, active strategies need trading signals. We need a good methodology for our trading signals specifically, and this requires months, if not years. It's not just a simple exercise to do. One should be also aware of the risk involved in a wrong signal, which is normally called model risk, so to say, because the model could be wrong from time to time. And depending on your framework, a signal might also not be necessary. It could be that we still involve only asset allocation strategies or rebalance our portfolio according to the allocation model and not the trading signal. But normally, for active strategies, we need trading signals. They are necessary. Scalability, that's also very, very important, as I mentioned initially, because it's normally overlooked. We build a small, sometimes we build a small script, maybe with Python, and we use it in production. That's okay, but whenever we need the same signal for something else, or to apply slightly different logic, add slightly different logic to part of the signal, such as moving average type, for instance, it could be an equally weighted moving average or an exponentially weighted moving average, or it could be, I don't know, something else, or we adjust the weights, for instance. And it is very important to keep in mind scalability. And for instance, some of the guidelines I consider most important are that parameters change and they should be adapted, or maybe you want to just use a different parameter from time to time, so keep it as an input. Don't just hard code any number in the script, but make it an argument so that you can basically provide it to the functions and adjust the strategy accordingly. Also, estimation routines should run sometimes and not just run once, but every few data points, or every few I don't know, maybe after some time, or maybe after some performance, they should be rerun to fit the model again. Of course, not at every single step, otherwise it becomes overfitting and it could be a problem, but it's necessary to just not stick to something that was estimated on a very stale data set. Also, we need to keep under control risk, and in this sense, model risk, so the fact that signals could be wrong. And finally, trigger conditions. So when should we calculate the signal? Asset allocation, execution, risk management could have different needs. So the signal itself, for instance, if we apply a risk parity asset allocation model, that could rely on the signal, so on the momentum signal, but also on another signal, which is maybe a trend following signal. In these two cases, we must be careful and say, okay, actually, we need to have a stable solution that basically, wherever the signal is, applies the asset allocation logic to the assets or selection that was made after the signal. So scalable in the sense that these parts should be interchangeable somehow, modular at least. And in conclusion, trading signals allow us to find an edge, that's for sure. We know that, but it's difficult to find it, that's also true, and use data technologies and methodologies. They are not necessary, but they are very important, and they can be a game changer for your investment strategies. And they should be scalable, and able to adapt or rerun according to different strategies, different conditions, different performance, different markets, and different asset classes.
Okay. Thank you for the presentation. And one question that I have regarding especially the sentiment and news analysis, is it something that it's a bit harder to do, given that it's more qualitative rather than quantitative? And how can you adjust based on the credibility of the source and how hard it is compared to all the other strategies?
Yeah, thank you. Absolutely, news is one of the most difficult fields where we can apply trading signals. Why? Because we definitely need, for instance, natural language processing models, so a model that can actually interpret the text and make it a number. So something that basically tells us, hey, this is a positive news and very positive, very negative. And also we need to basically deploy a little bit of qualitative filters, or maybe still they can be systematic and quantitative, but they must be anyway in place. For instance, if the news is reported by multiple sources, it's definitely more important than a news that is just by a single source. So definitely in that case, we have to increase, let's say, the magnitude of the signal, or maybe the sentiment value overall for the stock. And all these considerations, I mean, there's a word behind it, and it's a very specific field, which is actually very fascinating because it's modern, it's new, and for this we need to rely on good APIs, for instance, and providers that can basically tell us, for instance, how many sources provided similar news and all the rest. Sometimes they even come up with a sentiment directly that we can use. That's the case for a few APIs I know, but it could be helpful, for instance, to just use the sentiment as a number, and we plug it into the signal and trade according to the number. However, it could also be more meaningful or more important to apply a different methodology according to our needs.
Okay. So this I'm done with the questions for today. So make sure to stay tuned for the coming episodes that we'll do with Marco. And yeah, thank you, Marco, again for taking the time and explaining the basics behind the trading strategies that you build.
Thank you, Giacomo, and see you next time, everybody.
Okay, so this is it for today. I'm Giacomo. This is Also Hub. See you next time.